All right, Walter Wofford back. Another episode on the road to short-term rental cash flow. So we got a series and we're walking through it and we're looking at the different ways to generate cash flow with your short-term rental. All right, so we've talked about the base of operations, the digital platform, digital financial platform. That was in episode 1. Then we talked about acquiring with seller financing. Then we're going into a joint venture with somebody else who puts up most of the money. We've looked at inherited IRAs, and then we're now looking at the possible implications of using your retirement accounts in the short-term rental operation. So it's in the weeds. Just get ready, but you'll have a thorough understanding of the landmines out there. And I've got 7 possible scenarios that you can sidestep UBIT, which you would want to do if you want to use your retirement accounts to generate cash flow for your short-term rentals. Okay, so as always, I got Bill and Judy, the AI staff, helping me. If you want a copy of the ebook, download it immediately. Just look at the QR code, pull out your phone, center it on that, and hit the link, and it'll take you to a form that you can fill out, and then it will immediately send you the book. It's very helpful information. So thanks again for watching. If you like this video, subscribe, give it a thumbs up. Walter Wofford, thank you.
Okay, let's unpack this. Imagine the dream, right? Building wealth for retirement, maybe looking beyond just stocks and bonds. And you land on short-term rentals, Airbnb, VRBO, that sort of thing.
Yeah, very cool.
Picture your IRA funds flowing into this, generating income, maybe tax-free. It sounds amazing, doesn't it?
It really does. But then you can hit this potential roadblock, a tax thing called UBIT.
Exactly, UBIT. And this is where the whole idea of tax-advantaged retirement accounts kind of slams into how the IRS sees things.
Right. They might not see a simple investment. They might see, well, a business. And that surprises a lot of folks.
Absolutely. So this deep dive, we're going laser focused on exactly that intersection. We're digging into unrelated business income tax, UBIT, and specifically how it pops up when you use tax-exempt accounts like your IRA to invest in short-term rentals, STRs.
And we're pulling our insights, the strategies and stuff directly from the source material you gave us. Excerpts from Walter Wofford on UBIT workarounds for JV STRs.
Think of it like we're using his notes to navigate a tricky map.
Good way to put it.
Our mission today is really to get you oriented. We want to break down what UBIT actually is. Pinpoint what activities, according to this material, can trigger it with STRs.
Right.
And then, the important part, walk through the workarounds and strategies Walter suggests. It's about giving you the intel to understand the risk and see the potential paths forward.
Because the core issue, like you said, the surprise, is thinking your IRA income is totally tax-free.
Yeah.
And then finding out, whoops, the IRS has rules for when your tax-exempt account starts acting like a taxable business.
Okay, let's dive in then. Fundamentally, what is UBIT and why does it even matter for an IRA doing, say, a rental property?
So, UBIT, unrelated business income tax. The name basically gives it away. It's a tax on organizations that are normally tax-exempt.
Like IRAs.
Like IRAs, yeah. It applies when they make money from a trade or business that's unrelated to why they're tax-exempt in the first place.
And an IRA's purpose is retirement savings. Usually passive investing, right?
Exactly. Passive stuff, long-term investing.
And that's where STRs get tricky. Because running one looks a lot like, well, running a business.
Precisely. You're dealing with bookings, guests, cleaning, ads, constant turnover. It's very active.
So the IRS draws a line.
They do. Passive rent, like from a normal long-term lease, generally okay for an IRA, no UBI. But income from active business operations, that can trigger UBIT.
And that's a shocker. Your IRA might actually owe taxes. It might need to file its own tax return, that Form 990T.
Correct. It's a whole separate thing.
Okay, so the trigger is this business activity. According to the source material, what specifically waves that red flag for the IRS with STRs? What makes it look like a business?
The source hits on a couple of main things. It really comes down to the level of activity and the type of services being offered.
Okay, so is there like a hard line, maybe based on how long guests stay?
Yes, absolutely. And this is a really crucial detail from the source material. Actively managing an STR, it says, is often defined if guests stay, on average, less than 7 days.
Less than 7 days. Wow.
Yeah. That short duration, it makes it look more like you're running a hotel or some kind of transient lodging.
Which is a business.
Which is definitely a business in the eyes of the IRS, not just passive landlording.
Okay, so that short stay average is a big one. What about the services? You mentioned services.
Right. That's the second big trigger, providing what they call substantial services.
Substantial. What does that mean? Like clean sheets?
Well, the source makes a distinction. Basic stuff, like clean linens before arrival, or just general property maintenance, that's usually fine. That's inherent in renting.
Okay.
But substantial services are things offered during the guest's stay, like daily maid service, providing meals, concierge services, that kind of hotel-like stuff.
So it's the extra services during the stay that push it over the line.
Mm-hmm.
Makes the income look like payment for services, not just rent for the space.
Exactly. That's the thinking.
Got it. So short stays, extra services, those are the operational triggers.
Mm-hmm.
But the source also mentioned financing, something separate.
It did, yeah. And this is a different flavor of unrelated business taxable income, or UBTI. It's specifically called unrelated debt financed income. UDFI.
Right.
So if you use debt like a mortgage to buy or fix up the property inside the IRA, then a portion of the income that property generates can be subject to UBIT, even if you're not providing substantial services or having super short stays.
Wait, really? So you could avoid the active business stuff, but still owe UBIT just because you used a loan?
That's it. It's a really important distinction. The UDFI trigger is just about having debt on the property held by the IRA. The calculation gets complicated, but the trigger itself is the debt.
Okay. Short stays, substantial services, and debt. Those are the big UBIT traps for IRAs and STRs based on this source. Okay, now for the good stuff. The material talks about several workaround strategies. What's the main idea behind them?
The core principle, really, that ties all these strategies together in the source, is making sure the IRA's role is purely passive.
Passive, okay.
Yeah, the goal is to structure things so the IRA isn't seen as running the business, it's just an investor. Or a landlord receiving passive income.
Makes sense. All right, let's break down these workarounds. What's number one?
The first one is maybe the most direct, conceptually. Just change the lease structure. Focus on medium or long-term rentals.
So get away from those sub-7 days stays.
Exactly. Shift to renting the property for, say, 30 days or more at a time, consistently. That way, the income generally qualifies as passive rental income.
Which is exempt from UBOT.
Right. So you're targeting like traveling nurses, maybe corporate housing, people needing a place for 1, 2, 3 months.
Okay. Turns it back into a traditional rental. Tax-wise, that seems pretty clear. What's the next approach?
Second strategy involves a partner. Setting up a joint venture, or JV, with someone other than your IRA. In this setup, your IRA acts as a minority partner. The source uses like 30% as an example. And critically, the IRA only contributes capital, money.
So the IRA is the money partner.
Right, and then an active partner who is not your IRA, and very importantly, is not a disqualified person relative to you, that partner handles all the operations, the STR stuff.
So the IRA puts in cash, someone else does all the work in management.
Precisely. The IRA stays passive. It just gets distributions based on its capital share. The active partner gets paid for their work, maybe through management fees or a bigger slice of the profits.
And that warning about disqualified person sounds important.
Crucial. Absolutely cannot be yourself, your spouse, your parents, kids, grandkids, grandparents, or entities they control. That avoids prohibited transactions, a whole other tax minefield for IRAs.
Right. Okay. So JV with a non-disqualified active partner. What if you don't want an individual partner, but still need someone else to run things?
That leads right into workaround number 3. Use a third-party management company.
Like a professional property manager.
Exactly. Your IRA owns the property, but you hire a management company to handle everything else. Marketing, bookings, guests, cleaning, maintenance, the works.
And that makes the IRA passive because it's just like outsourcing the operations.
Yeah, in theory. The IRA is acting like a passive investor collecting rent, facilitated by this third party. It's similar to owning, say, a REIT stock.
Okay.
But there's a nuance here the source seems to imply. You still need to be careful that the management company itself isn't providing those substantial services during the stay.
So even if the IRA isn't doing it, if the manager is offering daily cleaning or concierge stuff,
it could still make the income from the property look like business income, potentially triggering UBI. So the manager's scope of work matters.
Got it. Okay, that's tricky. What's the fourth strategy?
Number 4 is kind of similar in principle but structured differently. Use a triple net lease, or NNN.
And
Yeah. Here, the IRA owns the property, but it leases the whole thing out, usually long-term, to another company or person. That tenant, the operator, is then responsible for running the actual STR business.
so the tenant pays the IRA rent.
Right. And the tenant also pays for all the operating expenses, the property taxes, and the insurance. That's the triple net part.
So the IRA is purely a landlord collecting passive rent.
Yep.
The tenant is the one actually operating the STR business.
Exactly. NNN leases are classic passive real estate investments. Same warning applies, though. The tenant running the STR cannot be a disqualified person.
Right. Always watch out for those disqualified people. This seems like a really clean separation. Okay, strategy 5 involves a different kind of company.
Yes. This one is using a C corporation blocker, sometimes called a UBI blocker.
Okay, how did that work?
You set up a regular C corp, and that C corp is the entity that owns and operates the STR business. Your IRA doesn't own the property directly anymore. It just owns shares of stock in that C corp.
So the business activity, the STR operation, happens inside the C Corp.
Right.
And how does that stop UBIT for the IRA?
Because the C corp is its own separate taxpayer. It pays corporate income tax on the profits it makes from the STR.
Okay.
Then, when the C corp pays out profits to its shareholders, including your IRA, it pays them as dividends.
And dividends received by an IRA are generally not UBIT.
Generally not. So the income stream reaching the IRA is clean from a UBIT perspective. The tax got paid just at the corporate level first.
Makes sense. But what's the catch? Sounds a bit complicated.
The main downside is potential double taxation. The C corp pays tax, and then later, when you eventually take money out of your IRA in retirement, those funds might be taxed again, depending on the IRA type and future laws.
Right.
The source suggests it's more complex, maybe something you consider if the other options don't work and the returns are really high enough to justify that extra layer and potential tax hit. Kind of the heavy machinery option.
Yeah, definitely sounds like more moving parts. Okay, let's circle back to that debt issue UDFI. How do you avoid that specific trigger?
Strategy 6 is the most straightforward way. Avoid debt financing entirely.
Just use cash.
Just use cash. Fund the whole thing, purchase. Set up using only cash from the IRA or maybe cash from partners in that JV structure we talked about.
Yeah.
No debt on the property means no UDFI trigger. Simple as that.
Simple. But maybe not always practical if the property is expensive.
Yeah.
Didn't the source mention an alternative if you have to use debt?
It did. And this is a really interesting point for people who might have different retirement account options. The source specifically notes that a solo 401k.
For self-employed folks or small business owners?
Right. A solo 401k is explicitly exempt from the UDFI rules when the debt is used for real estate.
Really? Exempt?
Exempt for real estate debt. That's a huge difference compared to an IRA. So if you're eligible for a solo 401k and you anticipate needing financing, that could be a much better vehicle for this type of investment, specifically to avoid UDFI.
Wow, okay. That's a game changer depending on your account type. Huge detail. All right, what's the last workaround? Number 7.
The 7th strategy is kind of a two-step process. Acquire and set up the property first, then convert it to a passive holding by leasing it out.
How does that work?
The example in the source is your IRA buys the property, maybe furnishes it, gets it all ready to be an STR.
Okay. Does the initial work?
Right. But then, before operating it, the IRA leases the fully prepped property to a different company again, not a disqualified person, and that company is the one that actually operates the STR business day to day.
So the IRA does the setup, then immediately pivots to just being a landlord collecting rent from the operator.
Exactly. As soon as that lease is signed, the IRA steps back from active operations. Its income becomes passive rent from the tenant. It's kind of a hybrid, blending the acquisition with something like the NNN lease idea.
Okay, got it. So those are the 7 strategies from the source. A lot of options, all focused on keeping the IRA passive.
Now, before we wrap, the source also had some really important compliance tips in that real-world example. What were the key compliance takeaways? Yeah, the source was very clear here. Number 1, keep the IRA passive. Absolutely no personal involvement by the IRA owner. No sweat equity, no managing, no providing services yourself. 0.
Hands off.
Totally hands off. Second, avoid prohibited transactions. This is related but broader. Don't mix personal funds with IRA funds. Don't use personal services for the property, and definitely don't get any personal benefit from the property now.
Meaning no free vacations for you or the family at the IRA's STR.
Absolutely not. It's classic prohibited transaction. Huge penalties.
Okay. What else on compliance?
Two really crucial points the source hammers home. First, always, consult qualified CPA or attorney, someone who really knows self-directed IRAs and UBI before you do anything. This stuff is complex.
Don't DIY the tax strategy.
Definitely not. And second, document everything. Keep meticulous records, operating agreements for JVs, leases, management contracts, anything that proves to the IRS how the deal is structured and that the IRA is passive.
Professional advice and a solid paper trail.
Yeah.
Makes total sense. And there's a case study. See how this works in practice.
Yes, Walter shared his own experience with an STR joint venture using an inherited Roth IRA.
Right.
The setup was, Walter and another partner formed an LLC for an Airbnb down in Gulf Shores. His inherited Roth IRA put in $100,000 cash, capital only.
Right.
The key part, a friend who was not a disqualified person handled everything operational. Bookings, guest stuff, cleaning, even furnishing. All of it.
So the friend was the active, non-disqualified partner doing the actual work.
Correct. The structure reflected that. The IRA was just a 30% partner based on its capital. The friend got paid a management fee plus a larger share of the profits for doing the work. The IRA just received its passive distributions based on its capital share.
And the result?
The result, as reported, was that the IRA was clearly passive. It wasn't operating the business. So no UBIT was triggered for the Roth IRA's earnings from that venture.
That really illustrates that JV strategy well. Separating the IRA's money from the labor and management done by someone else entirely. That seems to be the core principle.
It really highlights how important that careful structuring is and sticking to those disqualified person rules.
This has been, wow, incredibly helpful. We've gone from defining UBIT and seeing why it's a potential issue for IRAs and STRs. Identified those key triggers, the short stays, the extra services, the debt financing.
Right, the UDFI.
And then walk through 7 different strategies from the source material to potentially navigate around UBIT. Everything from just changing lease terms
to using partners or managers or even these more complex C-Corp blockers or thinking about a solo 401k if debt's involved.
And the consistent theme, the thread running through all of it, as the source kept emphasizing, is making sure that IRA stays truly passive. It's an investor, not an operator.
Absolutely. That's the number one goal.
And we can't say it enough.
Yeah.
Get professional advice. The material stresses this, and it's clearly not just a suggestion. It's essential.
Non-negotiable, really. The details matter immensely in tax law.
So when you think about all these different paths that the source laid out, you know, the simplicity of just doing longer leases versus the structural gymnastics of a C-Corp or a carefully managed JV.
Yeah, each one has its own pros and cons, different levels of complexity, control, potential, return.
Right, which kind of leaves you, the listener, with a really interesting challenge to think about, doesn't it?
It does.
Considering all these complexities, these trade-offs, what is the right balance for you between how much structure you need versus the potential return you're aiming for when you're looking at using tax-exempt IRA funds for short-term rentals?
Yeah, it's a puzzle, isn't it? The right answer is definitely going to be different for everyone. Depends on your specific situation, your goals, your risk tolerance for complexity. But hopefully, this deep dive gave you the pieces you need to start figuring it out.